Time for Hot Picks. Our guest covers the financial sector, and he says his three ideas stand to benefit from market volatility. We're joined by Ernest Wong, Head of Research at Baskin Wealth Management. Ernest, it's great to see you. They're pretty diversified ideas, so let's just jump in. I mean, they're very different ideas. Yes. National Bank of Canada would be one of your favorite lenders. What's the bull case on this stock?
So what we like about National is that as the smallest Canadian bank, they're very focused on finding areas of the market that they can compete effectively in. Like the retail bank is mostly focused on Quebec, which has a relatively different economic profile than the rest of Canada. And a greater portion of National's earnings come from wealth management and financial markets. And lastly, National has done a good job of carefully expanding into new areas, such as ABA Bank in Cambodia, or more recently, Canadian Western Bank. And one aspect to call out is that this quarter specifically, National had a outstanding result in their financial trading business, really benefiting from the market volatility in March and April, and more importantly, having the trading systems to be able to capitalize on that volatility.
So that's interesting. So only a portion of their profits come from just good old banking, earning a spread on the interest?
Yes, that's right. National has realized that as the smallest bank, they just simply do not have the scale to compete for residential mortgages in Toronto or Vancouver against TD Bank. And as a result, they've really focused on growing the area, entering into segments of the market that they feel like they can compete effectively on. And over time, this has resulted in a premium return on equity, and the stock price performance has reflected that.
Your next idea is TMX Group, and of course they're in the enviable position with some of their business of selling data. Their marginal cost is very low, but they get a good bit of revenue for it.
Yeah, I think many investors still think of TMX Group mostly for the TSX exchange, but they've really evolved to be much more than that today. They have a big derivatives trading business, which this quarter had an outstanding performance, really benefiting from investors using options and bond futures to hedge their market exposures. And I think the important point about this is that it really reflects the work done by the management over the years to grow investor adoption of derivatives like ETF options, like the 2 or 5 year Government of Canada bond futures along the curve.
Right, okay. And then also, of course, they do have this international presence as well. They're not just domestic market by any means.
Yes, so that's another aspect of their strategy, is to really grow the analytics portion of their business. So they did this through the acquisition first of a company called Trayport, which is kind of like a Bloomberg of gas trading in Europe. And that's benefited over the last couple of years, given kind of the issues of energy security and what's going on in Russia and Ukraine. And that's a business that's growing double digits and is a recurring revenue business that continues to grow. And the other thing that they've acquired is a company called Vetify, which is an ETF indexing provider. And again, this is a high margin recurring revenue business, which has really propelled the valuation of TMX Group as a whole, as more and more of their earnings are coming from these high margin revenue streams.
And then your final idea is MSCI, a big compiler of indexes, for example.
Yeah, so MSCI is the leading provider of indices, especially for international markets. Fund managers, hedge funds, ETFs, they license these indices from MSCI to benchmark their performance, do return attribution, to define their investment mandate. And it's a really high quality business with high margins and generates a lot of free cash flow. So given the market volatility and the concerns that investors have had about valuations in the US market and about things like tariffs, we have seen some outperformance of international markets, such as in Europe or in Asia, and investor inflows into international markets. And so MSCI is really the main company that is benefiting from all of this, as number one, as these indices outperform and MSCI takes a fee on the ETF. And then secondly, as investment firms launch new products to be able to benefit from international investor interest.